Welcome to our video on the rise and fall of famous financial scandals. Throughout history, there have been numerous instances of financial fraud and corruption that have resulted in financial losses for individuals, companies, and even entire economies. These financial scandals have had a significant impact on the people and institutions involved, as well as the global economy. In this video, we will take a deep dive into some of the most notorious financial scandals, the people and institutions involved, the impact they had, and the lessons that we can learn from them. Number 1. Enron Scandal. The Enron scandal, which came to light in 2001, is one of the most significant corporate frauds in history. The energy company, which was once considered one of the most innovative and successful companies in the world, was exposed for engaging in widespread accounting fraud. Enron's senior management and executives had inflated the company's profits and concealed its debts in order to make the company appear more financially stable and profitable than it actually was. This led to one of the largest corporate bankruptcies in history, with thousands of jobs lost and billions of dollars in investments lost for shareholders. The scandal also had a major impact on the public's trust in corporations and the government's ability to regulate them. Many people were angry that such a big and powerful company could lie and cheat so much without getting caught. In response to the Enron scandal, changes were made to accounting regulations, and the Sarbanes-Oxley Act was created to strengthen corporate governance and financial reporting. This legislation sought to increase transparency and accountability in corporate reporting, as well as prevent similar frauds in the future. The Enron scandal also highlighted the importance of corporate transparency and accountability. It also revealed the role of auditing firms in detecting and preventing financial fraud, and how they can be influenced by the companies they audit. The scandal was a wake-up call for the corporate world, and it led to more stringent regulations and oversight of public companies. The Enron scandal is a cautionary tale of the dangers of corporate greed, and it serves as a reminder of the importance of transparency, accountability, and ethical business practices. It's a dark chapter in the history of corporate America that serves as a reminder of the importance of protecting shareholders, employees, and the public from similar scandals in the future. Number 2. Madoff Scandal. The Madoff scandal was a financial fraud that was uncovered in 2008. Investment advisor Bernard Madoff was arrested for running a Ponzi scheme, where he had taken billions of dollars from new investors to pay off earlier investors. Madoff had promised his investors consistent returns, regardless of market conditions, and many investors believed that Madoff was investing their money in the stock market. However, Madoff was actually using the money from new investors to pay off earlier investors, and the scheme collapsed when he could no longer bring in new investors to pay off the existing ones. The Madoff scandal resulted in the loss of billions of dollars for individuals and institutions. Many people invested their life savings with Madoff and lost everything. The scandal also had a significant impact on the securities industry and led to increased scrutiny and a loss of trust in the industry. Many investors were outraged that such a large and sophisticated fraud could go undetected for so long. In response to the Madoff scandal, new regulations were put in place to protect investors and prevent similar frauds from happening in the future. These regulations included the creation of new oversight bodies, such as the Securities Investor Protection Corporation and the Financial Industry Regulatory Authority, and increased transparency in the securities industry. The Madoff scandal also highlighted the importance of due diligence and the need for investors to be aware of the risks associated with investing their money. It serves as a cautionary tale of how easy it can be to fall prey to fraud and the importance of being vigilant when it comes to investing. Number 3. Subprime Mortgage Crisis. The subprime mortgage crisis, which came to light in 2008, is one of the most significant financial crises in history. The subprime mortgage market, which had been booming for years, collapsed due to the risky lending practices of banks and other financial institutions. These institutions have been issuing mortgages to people with poor credit, many of whom could not afford the loans they had taken out. When the housing market collapsed, many of these mortgages defaulted, leading to a global financial crisis. The crisis had a significant impact on the global economy and led to the failure of several major banks. During the crisis, a lot of people lost their homes and their savings, and the economy became very unstable. In response to the subprime mortgage crisis, new regulations were put in place to protect consumers and prevent similar crises from happening in the future. These regulations included the creation of new oversight bodies, such as the Consumer Financial Protection Bureau and the Financial Stability Oversight Council, and increased transparency in the financial industry. The subprime mortgage crisis also highlighted the importance of proper risk management and the role of regulatory bodies in preventing financial crises. It revealed how easy it can be for financial institutions to engage in risky lending practices and how important it is to have proper oversight and regulations in place to protect consumers from predatory lending. The subprime mortgage crisis serves as a reminder of the need for strong oversight, transparency, and accountability in the financial industry. It's a dark chapter in the history of finance that serves as a reminder of the importance of protecting consumers and the role of regulatory bodies in preventing financial crises. The crisis also highlighted the importance of proper risk management and the need for financial institutions to be held accountable for their actions. It also urged the need for better consumer protection and transparency in the financial industry. Number 4. LIBOR Scandal. The LIBOR scandal, which came to light in 2012, is one of the most significant financial scandals in history. It was revealed that several major banks had been manipulating the London Interbank Offered Rate, a benchmark interest rate used in financial markets to determine interest rates for mortgages, credit cards, and other financial products. The manipulation resulted in the banks earning billions of dollars in profits, and it had a significant impact on the global economy. The LIBOR scandal was uncovered when an investigation by regulators revealed that several banks had been submitting false information about their borrowing costs in order to influence the LIBOR rate. This manipulation allowed the banks to earn higher profits on their derivatives and other financial products that were tied to the LIBOR rate. The scandal led to fines and penalties for the banks involved, and several senior executives were charged with criminal activity. The LIBOR scandal had a significant impact on the reputation of the financial industry and led to increased scrutiny and a loss of trust in the industry. In response to the LIBOR scandal, new regulations were put in place to protect consumers and prevent similar scandals from happening in the future. These regulations included the creation of new oversight bodies, such as the Financial Conduct Authority and the European Securities and Markets Authority, and increased transparency in the financial industry. The regulations also included stricter rules for the submission and calculation of benchmark rates and the implementation of new technology to monitor and detect any suspicious activity. The LIBOR scandal also highlighted the importance of maintaining integrity in financial markets and the role of regulatory bodies in monitoring and preventing market manipulation. It revealed how easy it can be for financial institutions to engage in illegal and unethical practices, and how important it is to have proper oversight and regulations in place to protect consumers and maintain integrity in financial markets. Number 5. Paradise Papers. The Paradise Papers scandal, which came to light in 2017, is one of the most significant financial scandals in recent history. A trove of leaked documents revealed that many wealthy individuals and companies had been using offshore tax havens to avoid paying taxes. Because of the scandal, people are paying more attention to how people avoid paying taxes and are calling for more openness in the financial system. The leaked documents reveal that many of the world's wealthiest individuals and companies have been using offshore tax havens to avoid paying taxes on their wealth. This included the use of shell companies, trusts, and other financial structures to hide assets and income from tax authorities. The Paradise Papers scandal led to widespread public outrage, with many people calling for greater transparency and accountability in the financial system. It also led to increased scrutiny of tax havens and tax avoidance practices, and calls for stricter regulations and oversight of offshore financial activities. In response to the Paradise Papers scandal, new regulations were put in place to combat tax avoidance and improve transparency in the financial system. These regulations included the implementation of stricter rules for reporting and disclosing offshore financial activities, and increased cooperation between tax authorities around the world. The Paradise Papers scandal also highlighted the need for greater transparency and accountability in the financial system. It revealed how easy it is for wealthy individuals and companies to avoid paying their fair share of taxes, and how important it is to have proper oversight and regulations in place to prevent tax avoidance. It also urged the need for the public to have access to more information about the financial activities of wealthy individuals and companies, to ensure they pay their fair share of taxes. The Paradise Papers scandal is a reminder of the importance of transparency and accountability in the financial system. It serves as a call to action for governments, regulators, and the public to work together to combat tax avoidance and ensure that everyone pays their fair share of taxes. Despite these scandals, the financial industry continues to evolve and adapt. New regulations and oversight have been put in place to prevent similar scandals from happening in the future. But it's important to remember that financial fraud and corruption will always be a risk, and it's up to individuals, organizations, and regulatory bodies to stay vigilant and ensure that the financial system remains fair, transparent, and accountable. These financial scandals have shaken the public's trust in the financial system and resulted in significant losses for individuals and institutions. But they also serve as a reminder of the importance of transparency and accountability in the financial system. And the lessons we can learn from these scandals can help us create a more stable, fair, and transparent financial system for all. Thanks for watching, and don't forget to subscribe for more weekly videos.